Welcome back to Good Returns. I'm Matt here with Garrett, and this is our April Monthly Roundup. We do these at the start of each month to zoom out, look at the bigger picture, and find out what actually happened versus what just felt like was happening.
Yeah, April was an interesting month, so I'm happy to talk about that. I'm excited to get into it and see how it differed from the first quarter.
Yeah.
So this is starting of the second quarter off to a bang for sure.
Yeah, it was definitely a great month. Markets did fairly well. S&P up 10%, Nasdaq up 15%, reaching all-time highs. But there's a lot underneath, that's worth unpacking, which is the point of this episode.
Yeah, we're going to go through what drove April. We're going to look at what the data is saying, and then we're going to close by looking at something we do for these monthly type episodes, the monthly roundup episodes, where we look at what could go right, what could go wrong, the bullish case versus the sort of bearish case, and talk about honestly, what we're looking for in the months to come.
Yeah, and before we get into this, just keep in mind everything on Good Returns is for educational purposes only. Nothing we say should be construed as individual or personalized advice for your situation. We're here to give you context, help you think more clearly. But if you do have questions, you can always reach out to us at momentumwealth.us, and we would be more than happy to talk about your specific situation so that we could give you actionable advice. So let's look at the numbers. As I stated, S&P up a whopping 10% for the month, Nasdaq 15%, Russell 2000, which is the small cap index, up 10%. All three did, in fact, hit new all-time highs. If you just looked at the scoreboard and nothing else, you could definitely say that April gave us what January tried to.
Yeah, well, I mean, yes and no. Yet to be determined. That's actually one of the talking points that we'll get to later. But it's a very similar setup, and if it holds, that's the question. If it holds. Most of the gains that we're talking about here happened really around two specific days, and it had to do with the ceasefire announcements. You had the ceasefire announcements on April 8th and April 17th, and then the market basically moved sideways, surged, headline, market sideways, another headline surged. This is sort of the pattern that repeated throughout the month of April. But yeah, to your point, ending really high. Bitcoin also participating in that rally there, up about 15%-ish over the past 30 days. So lots of positive signs.
Yeah, I would definitely say so. I mean, you also had semiconductors, if I recall correctly.
Yep.
Definitely a story for April. Sector was up, 40, 45, 50%. Definitely a pretty significant, winning streak. Now, what we did see happen in the month of April, towards the latter end of the month, is you did have a little bit of a transition where growth outperformed value. So that had reversed a little bit of that rotation that we had been seeing year to date. I'm still not convinced that that's a permanent rotation. I'm still leaning more towards the potential for value to year over year outperform on that rolling 12-month period as we continue throughout the year in each successive month. But still great news for the market writ large. But we did see a little bit of that rotation, which, a lot of the growth names, especially when we talk about software and other things that have been really negatively affected by AI, have gotten hit so hard.
Yep.
That
That's what I was about to say.
An outperformance during the last 3 weeks doesn't put them back to their October highs.
Right.
October of 2025 highs.
This is kind of a recovery in certain sectors.
Yes.
The other thing about semiconductors is that there is sort of there's an analyst view that semiconductors sort of lead both ways. And so when you have a pump up like this in the semiconductor section or sector of the economy or the market, what does that say for the rest of the market? And is it going to follow suit in sort of the same fashion? We get a really high pop from semiconductors. The same thing happened in 2022 to the downside. At the beginning of the year, we had semiconductors really taking it on the chin, and the market followed. So is that going to be the same thing? The other thing worth flagging, though, is that the average stock in the S&P 500 actually underperformed the index. So previous weeks, we've talked about this equal-weighted S&P 500 sort of outperforming the index, the S&P 500, the market cap weighted. So this is kind of reversing, like the value and growth conversation is sort of reversed for April. The index looks really good, and most of the stocks that make up the index had really a modest month. So there's a differentiator here. And that's sort of a rally that's concentrated in a handful of names, which is something that when we refer to market breadth, we would expect that a healthy bull market would expand beyond that.
Which could go into your viewpoint of really a recovery in those names. And is that a sign of things to come? And then we cycle back to year to date, what we had seen, which is more of an expansive bull market,
right?
More of an equal weighted
very possible
run. So it is oil all over the place. It's trading it's trading like a meme coin or a penny stock. I mean, it went as low as $80 and as high as 115.
Yeah,
round trip too. I mean, like up down, up down, up down. So it for the month ended up 7-8%, which tells you everything about how that particular commodity is being driven purely by geopolitical headlines.
Yeah, you got another headline this week, earlier in the week, that the UAE is exiting OPEC.
Oh, yeah, they said peace out. Peace out.
Yeah.
And the reason for that, as I'm sure you read and are aware, is they can increase production.
Yep.
And
then they're almost immediately going to do that.
Starting today, May 1st. I believe
that's
is
crazy.
The first day. Yeah, immediately increasing production by at least. It's hard because you're not getting real-time data, but if you look at the 20 million barrels a day that is disrupted in that area of the world, and then you look at the Iraqi oil fields, and you look at the pipelines that go through the Kurdish areas of Iraq, the increase of production there, and that's sending oil north. It's sending it not through, is that the Red Sea? The Gulf of Arabia?
Sure.
Whichever one is there. There's two of them. Whichever one. Point is, the oil's not going through the choke points in the strait. And so I want to say between 1 to 2 million barrels a day. The Saudis have increased with their shipping up to their northern part of their country through the pipeline infrastructure by roughly 3 million barrels a day. And then you have what the UAE is doing, which is between 1.5 to 2 million extra barrels a day. When you start chipping away, that 20 million really gets down to probably about an 8 million barrel a day disruption. And that's being offset in other areas of the world. The shale producers in the U.S., they are reluctant and slow sometimes to increase production, but I'm thinking 1 to 1.5 million barrels a day probably has already been increased or will be in the next week or two. So that move alone starts shaving off pretty big percentages of what's disrupted. And it follows the trend that we have been seeing from the Gulf, the GCC, the Gulf countries, where they are sitting economically, their reserves are gigantic, but economically they're sitting on a melting ice cube. And that's why you have seen the Saudis pivot drastically in trying to transform their economy away from an oil-dependent economy. And the UAE is now doing the same thing because they realize there's a brick wall of peak oil demand, and they've already climbed over top of it. And so you either use it or you lose it. And so they don't really care about the price quotas because the OPEC is a oil cartel that seeks to control the price of oil by controlling the supply of oil. And based upon the hierarchy of where you're at in that organization, you are in queue, meaning that the organization based in Zurich, Switzerland, decides which country gets to increase at which price point. So you have to follow these rules. And so the UAE is saying, no, thank you. We're just going to drill, baby, drill, I guess, or pump, baby, pump, whatever.
So we think it's a
do.
catalyst that other nations may follow?
It is 100% a catalyst because if they're not adhering to the quota rules and they're going to pump as much as they can, the others are saying, well, the price is going to go down. Well, I need to pump as much as I can to get the price while it's high. And so they start doing it, and then all of a sudden you see production continue to swell because they realize that if they're going to transform their economy away from being, oil dependent, then you have a very limited time to get that money out of the ground.
Yeah.
Right. Because it's worth triple what it's going to be worth maybe in 3 or 4 years. And you have to be scared out of your mind if you're these countries who have built unbelievable infrastructure and wealth that's mind-boggling. And you're looking at the Asian markets, you're looking at the Chinese market, and you're saying, good God Almighty, nobody is buying a gas vehicle, nobody is buying the the public transportation in the Asian markets have pretty much all shifted to new buses and things being electrified. And so you're looking at billions of people that aren't going to be your customers. And you just realize, again, it's in the ground now. It's worth X amount. In 50 years, it's worth nothing or very little. It's always going to be worth something, but it's, but yes, to answer your point, going down a rabbit trail, that's the first domino to fall. Venezuela, well, I guess that's the second. Venezuela would have been the first because they're gonna produce in a OPEC agnostic or OPEC plus agnostic manner.
Yeah,
they're not paying attention to any of that, and so it's going to be very interesting to see how it plays out. But I think good for world consumers, U.S. consumers.
Yeah, well, I was going to say, like last week we talked about the market being a tool that sort of prices in outcomes. They're pricing in the outcome, but they're not necessarily pricing in how the outcome is going to arrive. And so I don't know that this is necessarily something that people. It certainly wasn't a conversation that we were having.
No,
over
it was
the past
not
few weeks
on the
about
bingo card.
Somebody leaving OPEC and producing more oil, which would potentially lower the price and curb all the inflation worries and all this kind of stuff. At least the oil-dependent inflation worries that Powell has spoken of. But it's an interesting development nonetheless.
Who is Powell?
We'll talk about him in a minute.
Okay.
Let's get into kind of the 6 things that defined April. The first one, and we will get into this one, the rally that was built on relief and kind of the underlying question that is under there.
The big one. Ceasefire, de-escalation headlines. So the market definitely began to unwind what we would call risk premium. That had really been a headwind to equities, kind of some pressure on how far equities could run up through that first quarter. That's really the unwinding of that, and the kind of the disappearance of that risk premium is pretty much why April did what it did.
Yeah. So this is something that, my goodness.
Excuse me.
Rough day.
Rough day.
I was me last week, or like the previous 2 weeks. Now it's you. Yeah, so the diplomatic progress that we had in April is genuine. The ceasefire was extended. The Israel-Lebanon situation, kind of the rhetoric around a ground war faded. Markets priced that in, and it turns out they were right to. So this is another indication that the market is kind of looking toward outcomes rather than kind of what's in the news at the time.
Yeah, I mean,
like over a long period of time,
maybe.
It's still trading around headlines.
Yeah, I mean, it could be seen slightly differently, but I'll allow you to continue.
Yeah, I mean, the best case outcome hasn't even materialized yet. We still have the Strait of Hormuz, which is the physical piece of this, and it's still shut down, functionally closed. Naval blockade is still in place. So the diplomatic track, again, and the physical track, which we talked about last week, are kind of moving at different paces, but the market is pricing in one over the other. And it turns out that so far they have been right to do that. Or at least that's what we've seen in April.
I mean, the physical reality will catch up because it always does. You've had diplomatic occurrences that's kind of being the leading indicator to the markets. You saw when there was like a day of tankers trying to get through, oil collapsed like a meme coin, like a bad NFT. I mean, just instantly. But I think that in seeing that occur, that was the smart money. And when we say smart money, you're looking at people that are probably in closest proximity to the most valuable amount of data.
Yeah.
And it seems to be they've kind of they've priced out the worst outcomes. It appears. So I would just think, I mean, to a degree, I wouldn't worry too much on whether or not, if you're waiting, if you are a short-term trader and you're waiting for a headline to pop up to give you comfort, you've already missed out. So that's why you see that giant swing of risk premium fading, equities going through the roof, oil collapsing during that short period.
Credit markets confirming.
Yeah. Risk on the smart money went risk on. It just is what it is.
Yeah, I think that's right. I mean, we'll continue to watch the Strait. Kind of everything flows through there. No pun intended. But let's talk about...
and just to add some color to that, lots of stuff does. It doesn't affect our hemisphere. It just doesn't. And so that what we're seeing, and this is going to be a long-running dynamic that transcends politics, transcends kind of the temporal nature of the back and forth. Who's right? Who's wrong? Should we? Shouldn't we? It kind of goes beyond that. What you're seeing is the leverage that the U.S. has, because now it is a net exporter of oil, and it's a net exporter of oil with accessible ports in 3 different oceans. So that gives the country writ large more staying power and leverage for any disagreement or future global disagreement or conflict, for the next 100 years. And so I think that knee-jerk reaction, which seemed rational and logical at the beginning, which is oil is going to go to $300 a barrel. The reason you're not seeing that play out is because the true reality on the ground has changed. It's no longer 2008. It's no longer 2009. And it strategically has placed the U.S. in a position to where geopolitical things can be done, and it doesn't affect your pocketbook like it used to.
What still affects it?
And that's not placing not placing virtue or approval or disapproval on whatever that could mean to people as far as U.S. involvement and stuff. It's just the reality that it appears to me, just an objective observer, that the landscape has changed since that shale boom that occurred.
Yeah, I mean, that basically what you're saying is the best case scenario played out, and it wasn't that oil tripled or doubled. Yeah. We are still higher than we were 2 years ago with the price of gas, but is that going to come down precipitously with UAE leaving and more
it shows
production?
You too that even though you have periods like where international will outperform like last year, it still really shows you the U.S. is the best place because it's such a resilient economy.
We saw that in April too.
And it can power through smart government decisions and stupid government decisions. And it's good for people to live through it with eyes wide open, because it should give you confidence that whether the government does something that you like or don't like, or it's stupid or it's smart, wherever it falls, because over the next 20 years of your retirement, you're going to really love some things that the Congress and the government does, and you're going to hate some things. But you're seeing that the U.S. economy is so resilient that I'm perpetually overweight U.S. stocks. Even if you have periods where you have outperformance with emerging or international, it's hard to talk me out of U.S. stocks being the absolute best, most resilient place to be. And so it should just give you hope that even though there's the potential for worse outcomes, you're living through something that's showing you that this market and the stock market and this economy is very resilient. And we should all know that coming through COVID and all of that stuff and kind of experiencing, all of that.
Well, it sort of highlights the need for diversification, which is not just a buzzword in investing. There are pockets of the market that perform well, even when the S&P doesn't perform well. Yeah. And then there are pockets of the, international and emerging markets exposure that will give you some forward motion when parts of the U.S. economy are not. And so they all kind of play hand in hand. So you don't want to be like fully in one or fully in the other. It's always sort of a piece. Now, there are different parts of the cycle or different parts of the year you can look at. If you're looking at, if you're somebody who looks at moving averages, for example, you can look at these crosses and kind of figure out when you're not going to be in a certain sector, or when you're maybe going to be leaning really heavily toward domestic and kind of not toward international.
And you can see that too with policy risk, right? Because a lot of times when there's policy uncertainty, and when I say policy uncertainty, think about, those that make the rules, the regulations, the executive orders. There's policy risk sometimes. You get one party may prefer regulation or deregulation of certain industries, may favor one industry over the other, different policies. And so when things change, people get uncertain and they question their plan. But what you ought to be doing is working with somebody that's looking at the data and saying, hey, we're going to skate to where the puck is going. And there are going to be sectors of the market that are probably going to outperform. And so you turn that policy risk into a policy reward by being forward looking and not getting rattled by uncertainty or changes, which are real and they exist.
Yeah, I think that thesis is going to be tested later this year in the midterms. If the midterms go
historically as they normally would.
Yeah. I think you're going to see that would build the case for some positive market movement toward the end of the year. Which,
and I think if you ask me, regardless of
I'll ask you.
regardless of outcome and all that, who wins what, if Congress, if the structure of Congress changes, what do you think the market's going to do? It's going to be up. If the structure of Congress doesn't change, what do you think is going to happen? The market's going to be up.
Yeah,
right? 1, 2, 3, 4 years, right?
Yeah,
So,
I mean, it would be just kind of the immediate response and what that looks like.
which could be a buying opportunity, depending on how the market interprets things, or it could be. The closer we get, the data will kind of tell you too. It could be a nothing burger because we have seen that before during midterm election. Regardless of outcome, there have been periods where it's just the market's really just kind of shrugged it off. When you when you get out of the futures market night of or next day, it's just kind of depends on what the greater trends are, I guess.
Well, that's how you figure out what the underlying trend is and how strong it is by how it responds to those types of environments where, if you have a pullback and then an immediate, reaching that support level and immediate bounce off of that signifies kind of the underlying strength of the trend, either bullish or bearish.
Yeah.
But let's talk about really why the index doesn't tell the whole story.
We're at 29 minutes.
It's not really because we're
23. Okay.
Yeah, we had a little bit. So let's talk about, again, market breadth. It's our favorite concept around here. We talk about it all the time, but it's one of those things that sounds technical, but it's pretty easy once you understand it. So when you're in an index like the S&P 500, there are a couple of ways that it can go up. It can build value. Either a lot of different companies and a lot of different industries are all going up together. That's what we refer to as a broad rally. Or a small number of very big companies are driving most of the gains while the rest of the index is kind of flat or negative. And that's sort of a narrow rally is what you
could say definitely the end of April would be considered narrow.
Yeah, 10 of the 11 sectors underperformed the index. The average stock trailed by nearly 4.5%. You had semiconductors and the large tech names doing most of the heavy lifting again because they were so beaten down in Q1. Not necessarily a bad thing, but historically, you have sustained advances. When you have sustained advances, it sort of requires broader participation. So a handful of names driving the rally is kind of like a rough patch. If they hit a rough patch, the market feels it more than if it were spread out among the whole. Yeah. And so it goes back to our conversation where we always look at the cap-weighted index and then the equal-weighted index.
Which I think good news for the equal-weighted approach is the strong start to earnings season. The earnings season has been the best in years.
Yep.
And this is a part of April that really did not get a lot of attention because of everything else going on, but it is genuinely good news. So you have a disconnect from the average performance of the stock in the index and what the companies
for April,
what the companies are reporting.
Equal weighted index is still beating the S&P, not very much, less than half a point, but it's still beating. It's
still beating it year to date. Yeah. So I hope for continuation of that, and the healthy bull market is in fact the earnings.
Yeah, we have half of the S&P 500 companies have reported the first quarter results at this point. And the first quarter is on pace for the 6th consecutive quarter of double digits earning growth. So the beats, the people that are beating, the companies that are beating is well above average. So this is kind of the double-edged sword that we'll talk about later, where it's good news and also kind of potentially hard news.
Well, profit margins hitting over 13%. It was the highest on record. And that's a powerful case for the growth outpacing value, or not really even value, the growth outpacing everything else was potentially a harbinger of the expansion of the bull market and not a cautionary tale of a rough patch, but simply because, again, profit margins over 13%. It's significant.
During a period of time where you had oil escalations and wars and a 9 or 10% drawdown on the market.
It's incredible. We don't know is this the beginning of AI increasing profitability? We don't know. We don't know, is this a result of the unbelievably large capital expenditures that are going on for AI infrastructure build out? We don't know. Time will tell.
Yeah, all good points. We have analysts that are forecasting growth over the next 12 months. So, I mean, we'll just have to see that's one of the things we're looking at. We're going to talk about that at the end of the show, but that is one of the things we're looking at is if earnings can keep up.
And if they do, you'll see an expansion on the multiple. That's the price people are willing to pay for exposure to those companies. So if earnings miss, which they haven't yet, we're halfway through, then, that could put pressure, and that could put pressure towards some of the smaller companies in favor of growth continuing to outperform. It's what it's been doing the last 2 weeks. But as of right now, again, underreported, it's quite significant. So we could be on the cusp of seeing a multiple expansion that we have not seen in quite some time.
Yeah, it's a catch-22 though, because you have an example like a stock like Meta, who announced that they beat earnings. I mean, they were like 10.44 earnings per share versus 6.67. That's a huge beat. The stock price fell because of the CapEx spending, because of the forward signals in that respect were given more weight than backward-looking earnings, and so therein lies the issue. Like, you beat your earnings, but you're also spending an enormous amount of money. Like, how do you weigh those two?
No, the amount of money being spent it's shocking.
Yeah, I mean, massive AI spending. Meta's going to spend $125 to $145 billion for 2026.
Oh my God, that facility near Monroe, Louisiana is unbelievably large. We have one, Google is spending $3 billion on the one they're currently building right now in LaGrange, Georgia.
Yeah, it's a lot.
$1 billion.
And so
on a building, it's insane. And we have numerous data centers around here. Again, the Meta one over in the Delta it's crazy. It is.
Yeah, so this is what we have to weigh with.
It's insane.
This is what we have to weigh with. It's not just always necessarily
Well, I don't
about
say crazy
beating earnings.
in a negative manner. I'm just saying in general, it's
mind-boggling.
Yes. Okay,
yeah, this is just the thing that you have to watch out for is like it's not just all about the earnings. So even if they beat earnings, you can still have an environment where Meta knocks it out of the park on the earnings and the stock price falls like 5 or 6% the day after the earnings were announced.
Yeah.
So I mean, you have, there's all sorts of different catalysts that happen. You have Apple with a CEO change that's going to take place in like less than 6 months, which is kind of crazy. But you look at, again, the positioning specifically of Apple in the market and the fact that they're kind of falling behind in some respects, the main respect being AI. And so is that a direct correlation of what's going on with leadership changes? And is it, going to reflect in maybe, they have an interesting earnings report and then, the stock price took a hit in the short term. In the long term, I think it'd probably be all right. But it's just interesting to think about these catalysts that surround. It's not just about earnings. There are other factors that go into it.
Yeah, and you look at the short term knee jerk reaction of companies such as Oracle. Let's say they have unbelievably great margins. They have enormous amounts of cash flow. But then they say, hey, we're going to spend $300 billion over the next 3 years to build out this stuff, and then we're going to be able to make $500 billion already on the books, and the market, cuts the stock by more than 60%. Now, if it works, they're gonna make a lot of money. But then people are saying, well, it may not work. But I tend to appear, because we're just us with a lot of some surface level, some more complex. I don't want to say experiments, more or less projects that we're working on with artificial intelligence. It has crossed that Rubicon from being a Google alternative to actually being an assistant, to actually doing things for you. And we're seeing the real world economic impact of that beginning to occur, which is, as we roll the conversation now to the Federal Reserve, that's where you have Kevin Warsh, who is believing very strongly that we are already in a productivity boom, and that just like Alan Greenspan did, you have to cut rates because the productivity, it has a double-edged sword. You're going to increase productivity. You're going to increase the money supply through the banking system just through economic growth. But at the same time, productivity always lowers prices. And sometimes the ability to lower those prices comes with layoffs and the trimming of headcount, which if you don't get rates lower, you run the risk of those people not being able to shift into other areas in the economy and find other jobs. So I think that his replacement coming in could not really come at a better time. And that doesn't mean, and when you think of these things, or at least the way I think of them, you can't look at it from what I would want. You have to look at it like this is the environment we're living in, and who appears to be a good fit for the market and the U.S. economy. And it does seem that, again, his kind of Greenspan-like view on productivity and the role that it plays, if we continue to see the AI trend, which I have no doubt will materialize, if we continue to see it become more and more productive, we're gonna look back at this time and say, that was one of the key tailwinds for the market, was having that outlook. But let's look at the Powell situation. For context, for anybody who may need it, Jerome Powell's term as the Fed chair was set to end in May.
It is still set to end in May.
Oh, yeah, it's going to end in May.
His chair term.
Being the leader of the Federal Reserve.
Yeah, he's still a governor. He still has a governor term that will go till 2028. Yeah. And so that's the interesting kind of paradigm here, which is that we looked back at the precedent of a Federal Reserve chair still staying on in a governor seat after their term ends. And I think you have to go back to, what did we
1948.
Say? Yeah, 1948, yeah.
Yeah, and that goes back to a time period where you had some real hardcore contention between President Truman and the Treasury. Excuse me, President Truman, his Treasury, and the Federal Reserve. And so he kind of, stood on, because through World War II, FDR essentially forced the Fed to peg rates to the Treasuries as a price control mechanism. And Truman obviously wanted to continue that trend as the lending to Europe became a big, was still going on. And then the arms race that started and began after World War II. So there was a little battle that occurred. So really 1948 is the last time that it happened.
Most modern Fed chairs will step down when their term ends as chair. They don't stay on the board. And so what's interesting is you have Powell, who has indicated that he would step aside. He was waiting on the DOJ matter to be resolved. That was resolved. That was kind of holding up Warsh's confirmation. Now it's not held up any longer. It's moving to the Senate. And Powell's saying, you know what, I actually am going to stay.
Yeah, and although he doesn't say how long he's going to stay.
Well, his term ends in 2028.
So, these things, I don't think it matters that much. To me, what matters most is the trajectory of rates, which is down. And whether or not it's a clean handoff, it doesn't really change the destination of downward rates, because Warsh's positions are very well known. I do believe we're probably going to see more of a Treasury Fed accord in some regards that's similar to post-World War II monetary policy, just simply because of having to deal with the significant amount of debt that was accrued over the last 5-6 years. So I don't think that anything really changes that, but it is interesting. And if you ever go, if you go and read the tug of war between the Federal Reserve and various administrations over the last 100 years, this is nothing new. It's nothing new. There's always, we were talking before the show that LBJ physically assaulted his Federal Reserve chairman, or the guy that was chairman when he was president, physically.
I could believe that from LBJ. Have you ever heard any of the audio tapes of LBJ?
Yes. Yes. Not for the faint of heart.
Yeah, he was an interesting guy.
He slammed a dude up against the wall for raising rates during the Vietnam War. So these disagreements.
So it could be worse, is what you're saying.
Oh, yeah. Yeah, absolutely. These disagreements, it happens.
I think it's just more of a, like, why would you? Right? I mean, if you're Jay Powell and your term is over and you've kind of, your term wasn't easy. I don't think there's any kind of, I mean, you had a lot thrown at you in your term as Federal Reserve Chairman. So you're also, however old he is, I mean, like, why would you not just say, all right, I'm gonna let the next group have it? So it's just interesting because Jerome Powell is just he just continues to be, I mean, I don't know, would you say a polarizing? He's not super polarizing, but he is, like, the previous conversations we've had about him, like, making a point in his pressers to talk about valuations of the market and stuff like that. It's just like an interesting take on the Federal Reserve chair and, like, what they're, what they actually should be paying attention to.
There's something called the Shirky principle. And this is always a healthy way to view any type of organization's actions and behaviors, because it helps with inconsistencies, with contradictions, with things that you may not think make sense on the surface. But it's a theory that became popularized that institutions will always act to preserve the problem upon which they are their solution. And then there's another train of thought that the specific name for it escapes me, but that any group, any organism will always act to reinforce its own preservation, period, full stop, end of story. And we talked about this last week with the credibility of what drives, what's the motivation for interest rate decisions sometimes, whether it's actually what is objectively good for the people upon which these institutions serve, or whether it's the credibility. But then the credibility and the preservation of that credibility could in fact be greater for the people that they serve than the direct impact of their interest rate policy. So it's very interesting mind games and different ways you can go to think about it. But his desire to stay, I would say, primarily is over what he would view as the preservation of the institution, the relevance, the credibility, and
but no other, other people.
But him staying presents the very same problem that him leaving would solve, right? So it perpetuates the situation. So
it's like a trying to turn a page. That's what I would say. Trying to turn a page, and it's kind of, you get halfway there and the page won't quite turn.
But it's just organizations, which are just made up of groups of people, will once they are established, which the Federal Reserve or any institution that may be like that is established, will always prioritize their own survival and their own relevance. And that does not mean that act is a net negative or a net positive, because there could be, again, second and third order effects that it actually makes sense for that I guess you could say not altruistic, but selfish desire of that organization or the people that represent that organization in their actions. Still good benefits could come from it. So I don't know. We'll see. I don't think he'll stay around very long, but at the end of the day, it doesn't really matter, because there are gravitational forces at work that really preempt any policy or personal back and forths between the various institutions.
Possibly. It's just something to keep an eye on. We got to move quickly through these next ones. We're already going over time, but let's talk about the economy just a little bit. We have GDP grew 2% in the first quarter. A real rebound from the near stall growth at the end of last year. Manufacturing, we've talked about, is in the expansion territory and has been for the past 3 months. Consumers have kept spending despite what we talked about with surging gas prices and consumer sentiment near historic lows. And unemployment edged lower to 4.3%. So the labor market is softening a little bit. It's bending, but it's not breaking yet.
Yeah, inflation headline. You had headline 3.3, a preferred core at 3.2. Here's the deal: when you strip out, just look at core prices that strip out the volatile other components they use. We're running at 2.6. So story year to date, inflation trend is slightly elevated, but it's not moving strongly in either direction. So we seem to have reached an equilibrium that seems to kind of be unbroken right now.
Still above the Fed's target from their own data. We have other private companies. We've talked about Trueflation on here before. They are actually saying that we are well beneath their target.
Yeah, well beneath
what they're looking at.
And as oil markets stabilize, we'll get a better view of the picture. Generally, as we saw, when it comes down fast. So can't really be looked at as structural when you have a component that is that volatile, which is why they strip it out and when they look at the core. And so once that's solved, we'll really get a good hold on if the downward trend that really started in end of 23, 24, how does that continue? But let's look at sentiment and technicals.
Yeah, it's the last one before we get to what we're watching in May. This one's more observational than anything else. The technical picture improved pretty dramatically in April. The S&P 500 fully recovered from the March drawdown. It closed near all-time highs. You have credit spreads tightening, volatility falling. By most of these measures, the picture of the market is constructive. I think that's what the takeaway is.
Yeah, and it tells you how this year's really felt heretofore to regular investors. You have the scoreboard looks good. You got the experience of kind of living through it, drawdown headlines, bad weeks. It does have a kind of a healthy framework now for as we kind of ease as investors and different people kind of ease back into their maybe increasing their 401k now that they've seen the world hasn't ended and those types of things. It always generally, from my experience, those types of pullbacks and situations do kind of set a new floor for the next leg up, the next run.
Yeah, you have generally when you look at markets with a lot of skepticism, still on the sidelines, that's a natural source of buying power. We talked about that before, kind of people waiting for an entry point into the market as conditions improve. So if we were looking at a situation where you have like euphoria in consumer sentiment, that would maybe be something that would give you kind of cause for concern.
Another element of the bull case that I think is probably pretty genuinely strong is that, again, 6 consecutive quarters of double-digit earnings growth. You got record profit margins, labor markets holding, manufacturing is expanding, credit markets look very healthy. The rate hike risk that had weighed on things earlier has pretty much disappeared as we predicted it would. And if you look here, a situation where the Strait reopens, oil falls, inflation eases, the Fed gets room to move. It's a very healthy environment.
Yeah, that is definitely something we're looking at for the most positive case of the market over the next few months. The AI angle is very real too. The semiconductor run up in April is not something that was speculation. It actually happened. It reflects genuine capital spending on AI and the real expectations of productivity. So if that continues to play out, the earnings story does have some legs under it.
Yeah. And the negative side of things, depending how long the Strait closure is, these different blockades, how did April's rally price in resolutions? Is it forward thinking 6 months from now? Is it forward thinking 2 months from now? So there's all kind of things that be prepared to see headlines on that, don't panic, stay disciplined. Valuations technically could be considered high if earnings don't grow, but now again we're halfway through earnings season, and what are we seeing? Record profits. So that every
but
day,
it begets more and more. It has to have more and more and more.
So we'll see how that pans out.
Yeah.
It to me it seems like that's becoming each day that passes is becoming less of a risk. But
it's the kind of the thing that separates us. We get conversations, or at least I have, where people will mention, the 2000s, the dot-com bubble. And so this is kind of one of the things that is separating us from that period of time, our earnings, because you didn't have the same environment back in.
They weren't making $1
or 2000,
not $1.
Yeah. So the fact that the earnings are there and they are real and they are verifiable, you can look at them, you can see them, that kind of separates us from that time period. But that said, it does constantly raise the bar. So you get higher and higher and higher, and you have to have more and more and more. And what does that mean later on down the road?
Yeah. Well, the fact that consumer spending has been muted. So if that situation resolves, that's even more of a tailwind for earnings to expand. So, we'll see.
You also have housing, which is it gets relief from interest rates being lowered.
Housing market's been basically forgotten about as an area of investment, to be honest with you. But you have the AI story we talked about. Enormous spending expectations are high. So these investments, while they are gigantic, I'm trying to figure out different words and adjectives to use to describe it, but they are large, have not really, just so you understand, like the NASA budget is what, like $30 billion a year. They're going to spend 20 times NASA's budget this year on the build out stuff. It is big.
Yeah.
It is big. And so what is the ROI going to be? These companies think the ROI is going to be obviously multiples more than they spend, or they wouldn't spend it. And the bond market believes them. They're giving them the money. They have Oracle raised the single largest bond raise ever in history. I think it was in December. They had no problem, like $50 billion, no problem in one raise. So that's the bull case. Fundamentals are strong. It looks like diplomatic progress is real to help solve some of the near-term headwinds from headlines and geopolitical risks. So that appears to be positive. And then we do have the bear case, right, that you want to kind of pay attention to a little bit, just to, be emotionally prepared if something doesn't go your way. So did the market get ahead of itself with earnings, or is it actually pricing in the proper expectation? When the physical supply situation changes, how will that affect things, and how will consumers react to that change?
Yep.
So, but we covered a lot of stuff. We'll be obviously watching resolutions in geopolitical events, watching the Warsh confirmation, watching how the Jay Powell situation resolves, big tech earnings, Microsoft, Alphabet, Meta, Amazon, AI capital spending. We got a lot of stuff to pay attention to that we'll be bringing you. This month is probably going to be one of the most interesting months of our podcast, in history, because of all the catalysts that are kind of lining up. So make sure to stay tuned.
Yeah, that is a good place to end it, I think. All-time highs, investors stay the course through the first quarter's drawdown, through the bad weeks, through the difficult headlines, through the whipsaw trading.
We didn't
They're
even
looking
get
at recovery.
We didn't even get into some of the really significantly positive structural improvements in the blockchain area.
Oh, yeah.
We haven't even touched that, and that we'll save that for maybe next week or the week after. But
you have some interesting developments with Stripe and what they've announced with the technology that they're embracing. The banks are also trying to embrace that sort of stable coin. Yeah. So that's interesting.
Which all really feedbacks to Ethereum, to Bitcoin, to, that whole space. And that's something that's really been forgotten about for the last month, and rightfully so. There's a lot more interesting things because, that was kind of going through a recovery cycle, but we've got some very interesting data points and some really positive, the best performing asset class last month was, in fact, Bitcoin. So
yeah, I mean, the honest takeaway here is that the framework, they're not promised a straight line. We're not promised the market's going to go up forever. We're going to have periods of time like this. We're going to have pullbacks. We're going to have things that happen. But, holding through the uncertainty is how the framework works. If you have a plan in place and you know exactly what your goals are, that is going to be your North Star. And so you're not going to be worried about trying to avoid these kind of periods of times where you have these short-term, the short-term pullbacks and the noise and all that kind of stuff. And it's very important to be able to separate that, the something that matters versus the stuff that's just noise.
Yeah, absolutely. Well, that is a wrap for good returns.
Yeah. We'll, let's see. Yeah, we were over this week. So anyway.
No, a little bit.
Yeah.
Not too bad. Well, thanks for spending time with us on this monthly roundup.
Yeah, we'll be back next week with a full rundown on the Warsh confirmation.
He's actually going to be a guest on the podcast next week.
If only I have like a sock puppet or something. The big tech earnings picture. Subscribe if you haven't. Share with somebody who you think would find value in it. And we will see you next week.
Yeah, absolutely. Everybody take care. Stay focused. Tune out the noise. And we will, in fact, see you next week. Or you'll hear us. We may not see you, but you'll hear us. You'll see us next week.
Yes. Goodbye.
Take care.